All right, so let's continue on. So the information to prepare the statement of cash flows is going to come from three sources. It's what we already have. It's going to be from our comparative balance sheets, the current income statement, and any additional information that we may have. Okay, statement of retained earnings, notes, ledger accounts, anything else we have. Okay, all right, all right. Indirect method. All right. So direct method, it just says cash receipt from customers. You're going to start from your beginning balance, and you're just going to run down cash in, cash in, cash out, cash out. That's it. What we do on the indirect method, we are going to analyze the changes in accounts receivable, the changes in merchandise, changes in prepaids, decreases or changes in accounts payable, the changes in any other payables we have, and see what our net cash provided from our operating activities is. All right. So as we work through the homework later, this part is the kind of the low hanging fruit. This is the easy part that most people get because you know that these items are usually tied to our sales and our transactional things, as we call it, in our operating cycle, and it's tied to, again, as the word says, in our daily operations of our business. So it's not as confusing as usually as investing and financing is. So we're going to list these out to provide some kind of net cash from our daily operating activities. All right. So we would go back here on our income statement. All right. So we need to find two things right off the top. All right. One, we need to look for depreciation because it's a non-cash entry always. All right. And then we'll look at when we look at this entry again for gain or loss on the sale of assets. So if we remember on the gain or loss from the sale of the assets entry, there's four pieces to that entry. All right, we've got the cash that we sold it for. We are removing the accumulated depreciation. We're removing the asset, and then that little plug figure, our balancing figure, is the gain or loss. Whether it's going to be a debit or a credit is depending upon how much cash we got. It depends upon how much accumulated depreciation, what the net book value of that asset is. But the only thing that shows up on our income statement is this gain or loss. The cash doesn't show up on our income statement. So remember, we're adjusting our net income. So we always adjust back this gain or loss on sale of assets as well. It's a non cash entry. So you immediately add it back. So if this is a loss on my books here, if I have a loss, it reduced my net income. So I need to add it back. If this is a gain, I need to subtract it. I need to do the opposite because I want this net income to go back to zero as if this never happened. And then when I get into investing or financing, I will take the cash from that entry and I will add it back because I want to know what actual cash came in my bank account. I don't care about the gap based net income part of it. I want to know how much cash I received. I could have received $2 million in this transaction in cash, but because I gave up assets, I lost $6,000 because of my net book value. My assets had a $2,006,000 net book value, so I lost $6,000, even though I got a $2 million check. I'm concerned about the $2 million check right now. That's what I want to know. All right. So here is the start of our analysis on this. All right. If I had $40,000 in receivables last year, and I end up with $60,000 in receivables, think through an entry that makes that happen. Assume no other entries have happened this year. Think there's been no other sales. All you have is one sale. All you have is one transaction that makes that balance true. All right. I would have to debit accounts receivable and I would have to credit revenue or sales, whatever. We always credit revenue. So I'm debiting my accounts receivable and I am crediting sales. That's the entry, right? Remember, because customers have two ways to pay. They can pay with cash or they can pay with paper. In this case, they pay with paper. That's the assumption I'm making to make that balance true. All right. So in that transaction, is that revenue? Yes, it's legally my money because I have the ability. It was earned. I sold them something. They're going to pay later. But did I collect it? No. So when my accounts receivable goes up, what happened to my cash in relation to net income? Do I need to adjust my net income down or up as it relates to my sales transaction because my receivables have gone up? All right. My receivables went up, which means I did not collect the cash. So I need to take my GAAP based net income and I need to adjust it down because I did not get the money. It's income for GAAP, but it is not cash coming in. All right. So all of these work the same. All of these, once we're doing this, it all works the same for the current assets. So think about inventory. All right. If I started with 70,000, one transaction makes this. Just think about it like it's one transaction. There's going to be several that go in and out of there to make this balance happen this way. All right. But what I would have to do is, and I'm getting messages from, we're posting funny things on our teams within the department here. What we would have to do is buy inventory. Okay. So I would have inventory and I would credit cash. Now, if my inventory went from 70,000 to 84,000, does that go through my income statement yet as cost of goods sold? It does not because I still have it in inventory. It's still mine to sell later. But the assumption is I've used cash to pay for it right now. Assume all this is cash. All right. We'll deal with this later when we get down to our accounts payable. It'll all work out because I'm going to deal with it on my accounts payable transaction later. So in this case, I had $14,000 where my inventory goes up. All right. So that means for net income, adjusting cash on income, I still have to also decrease my net income by $14,000 because I used that net income to buy more inventory that I still have. All right. I hope that's logical of what I'm doing. I'm using this cash to pay for inventory that I still have. So my cash flow is decreased by doing that. All right. So for accounts payable, if I started with 40,000 and I ended with 35, all right. What I always think of is if I had 40 and I know that I have some purchases this year because now I've already seen my inventory go up, what I did was I took this year's money, this year's net income, and paid off last year's bills. Not only did I pay off what I bought this year, I paid off last year's, some of last year's too. I've decreased what I owe my vendors. So, again, put it in personal context for you guys is that I'm using this year's money to pay off credit card balances that I had last year. All right. So while I've made money on my W 2, I have less money in my bank account. So I would also have to decrease my net income in relation to cash. I'd have to make that as a negative in my operating. All right. That's a decrease to cash because I don't have the cash anymore. All right. Interest payable will be the same. Now, income tax is payable. Right? That's something I'm going to have to increase because it's an expense on my books, right? But I haven't paid it yet. So that actually, it's more cash that I have in my bank account because I didn't pay the expenses yet. I hope that's logical. If it's not, I want all of y'all to email me. I will answer every one of these and try to explain it a little better. Y'all can come to my office and see me because that's the we try to look at how are we doing this from one year to the next or from one period to the next as to what this is affecting my cash and how this account got to this balance in relation to where did I get the cash from? Did I use this year's cash to pay off last year's balance? And maybe it's possible that if our accounts receivable goes down, okay, let's do it in the opposite. If I started with 40,000 and my accounts receivable went to 20,000, that means that I collected last year's money this year. That's not going to be in this year's net income because I showed it in net income last year. So I could take this year's net income and increase it because I have more cash than I'm showing in net income for this year because it was shown in last year's net income. So it's actually, and it makes it an increase because I've collected this year's money or last year's money this year. All right. It's not, we're trying to completely analyzing cash. All right. We've done our gap based financial statements correctly. They are correct. This is just a analysis of essentially one account, and we're using our entire financial statement to do that.